Hey, welcome to the show, Total Financial Solutions, Safer Money Hour. I'm Arif Halaby along with Jeff Gerard in your place for news, talk, and information. On AM 1220 KHTS, every week at this time, we're talking about your family's finances, of course, getting out of debt, managing your money, and planning for your retirement. So what are you going to do if you are retired or getting close to retirement, and you're saying, you know what, do I even need life insurance in retirement? Should I cancel my policy? In fact, we just dealt with this morning. A lot of times people will say, I don't need life insurance in retirement, and most of the time they're probably right. The policies, especially the term policies, have a purpose. Their job is to be there for a time when you're trying to build up your retirement accounts, when you're trying to make sure your debt is paid off, or if you have obligations, future obligations, like maybe your children's college, etc. And term insurance has that role to play. It is there for a purpose, and that is filling that gap in case you were to pass away before those obligations are met. But now let's fast forward. The obligations are met. You're retired. You have a policy that you've kept and you forgot about it, or it's just been there and you're not sure if you should cancel it yet. What are some of the reasons that you may want to keep it?
Well, you take a look at the core of why people buy insurance, and you touched on it greatly there. It's really to fill a gap, a financial gap, a need at a specific time. But when it reaches, I guess, the end of what we would deem its value, there are other things that a life insurance policy can do. Number one, namely, and I think a lot of people forget this part, is there are sometimes living benefits. And what I mean by that is a policy may not inherently have any equity to it. However, meaning no cash value, but if you were to get sick, if you were to have a critical or chronic or even a terminal illness, which we've seen in some cases, there might be a portion of the death benefit that you can access without dying. And that's where the living benefit really can come into play and help you financially in a time of need when you may need someone to come into your home and take care of you.
So let's explain what that living benefit is. It gives you a chance to pull out some or all of the face amount, which is the death benefit that would be paid to your beneficiaries. So $200,000, $500,000, whatever that big number is. It allows you as a person who's alive to get pieces of that, generally on a monthly basis, while you are ill or needing it to pay for your medical expenses or in-home care. It's beautiful because it can help soften the pressure on your normal everyday expenses and income. Meaning, you may have $5,000 a month in retirement income and be living fine, but all those $5,000 have a home. They're going to pay your bills of some sort, entertainment, insurance, etc. However, now add on top to that, these outrageous deductibles, right? The whole Obamacare thing, really what it did is it shifted we're not going to have insurance to now you have insurance, but with a $12,000 or $10,000 deductible.
Right.
Those things are huge, and they're annual. So that means this year and then next year and the next year. So these are dollars that you and I may not have planned for 15 or 20 years ago when we were working on our retirement plan, was to have a $10,000 deductible. So all of a sudden, just normal medical care that you would have to go through on a regular basis, you suddenly have this huge hit on medical. So,
and where are normally people pulling that from? They've saved and socked away dollars that they've never paid taxes on. So now they say, oh, I've got this IRA or this old 401k that I've parked, and it's earmarked strictly for medical. You've never paid tax on that money. So it's going to cost you maybe, let's say you need $1,000, or let's say $10,000. It may cost you $12,000 or $13,000 or $14,000 from that account just to net $10,000 in your hand so that you can pay those medical expenses. So having a life insurance policy with a living benefit that, oh, by the way, is tax-free to you, that's another reason to keep that, so that you can kind of have that tax diversity in case you start to see a need for a benefit.
Yeah, that's important if you're looking or living right at that cusp of the next tax bracket. So if you're somebody who's right at that edge and you've been planning a life financially, then suddenly you've got to pull money out of that retirement account, it can jump you to that next tax bracket. So important to think about. And Jeff, when you're saying the living benefits, that means it's you that's still alive.
Correct.
Still able, because a lot of people say, I don't want life insurance. The reason I don't want it is because it only benefits my kids. Well, it can, or your spouse or others, but here's a feature that allows you to benefit from it at the same time. So terminal illness, chronic illness, right, which is let's say pulmonary stuff that just keeps going on and on and on, and you're not getting any better, well, it's a chronic illness. You're not going to die, but you're not getting a whole lot better, but you do have to suffer through this stuff. It's those types of things. What else might it be that's something that would be considered a chronic or a living benefit?
Well, if somebody has less than 12 months to live, a terminal illness, so to speak, we see a lot of that where someone forgets that they may have a policy that may not have equity. Like I said earlier, it may be a term policy, but what if you convert that policy? What if you turn that from a term policy that had an expiry period, right? You bought it 20 years ago or 19 years ago, and you're 1 year from the time in which you'd say, look, I paid for all these years, but I'm just going to let this go. I'm not going to pay it anymore. And then the policy basically disappears. You may have a provision that says you can convert it to a permanent plan. And look, it's quite frankly, you're 19 or 20 years older. It's not going to be the same, maybe easy payment that you had, each and every month for the last 19 years, or 20 years. But if you have a need to fill, this could be the lowest cost way to maintain that benefit. And then, oh, by the way, the next month or whatever the period is, you convert that, and now you start accessing the living benefits. And part of what happens, and look, I want to put a little disclaimer out there. Not every policy is designed the same. Not every policy can be converted. Not every policy has living benefits just because it's a permanent plan. So you have to take a look at your policy, and I know it sounds kind of boring, but this could be the difference between something you threw away that had tons of value to you, potentially, or something that was just like, oh, okay, well, I guess we bought the wrong one back 20, 15, 30 years ago. But I think if you take a look at it now and you have some lead time between now and your retirement, now and maybe when you think you might get sick or you might need it, let's call it late 60s, 70s, 80s, there may be a chance to still kind of step into this thing, into a policy or a concept like this where it's not going to cost you an arm and a leg financially. So taking a look at a policy that has these benefits, oh, by the way, you were paying premiums. If you go on claim and you start drawing these living benefits, you don't pay any more premiums. So it basically acts like a safety reservoir, if you will, where you have this bucket of dollars that you now get to access and accelerate without having to die. And I think more and more people now, if you take a look at the statistics of 1 in 3 people needing long-term care at some point in their life, and the fact that people are living longer, look, advancements in medicine are wonderful. But if you don't live healthily, I mean, take a look at it.
What is it? It's called, man-made created illness is actually chronic illness. It used to be you would have some disease or something and you would pass away rather quickly.
Right.
Today, diabetics can live a very long time. People with congestive heart failure can live a very long time. Pulmonary issues, which are their lungs, a long time. So there's a lot of pressure on people's lives when it comes down to living, and that's one of the benefits. Well, let's come up with another one, Jeff. What about working in retirement? A lot of people are still working.
That's right.
So even though, quote, you're retired, you may not have enough if you pass away, which means you're now going to stop working. Your spouse now might still need some cash, so how do we fill that gap?
Well, and that's kind of the new retirement that we're seeing as well, that people will retire from their field or their career, their industry, but like you said, there's still a need for some income to be coming in other than maybe a Social Security payment that's coming in. And maybe, gosh, how many times have we seen this, that someone's working for an industry for 20, 25 years and there's no pension in the last company in which they worked, or the pension that they accrued from the company that laid them off 15 or 20 years ago is only a few $100s a month, and they're saying, wow, that's not enough combined with Social Security that I have to still work. So if you're having to work in retirement to supplement your lifestyle, and let's say you have someone counting on you, or like Arif said earlier, you still have a mortgage payment, some type of financial obligations, if you will, a car payment, your insurance, whatever that is, you may still need to work. And if you were to pass away, that income goes away because you're not there tomorrow morning at 9 or 10 o'clock. So that that insurance can fill that gap, especially if you've built your household finances around 100% of whatever's coming in on the passive side, meaning a pension or Social Security. Your active side, which is you going to work for that money, if part of that goes away, insurance again comes into play to fill that financial gap. And I think we've lose sight of that a little bit, that even if we are working and we're quote unquote semi-retired, we may still need to replace that income if we pass.
And that adds to that extra source of revenue that may be needed. If one of you dies, remember, you lose the Social Security of the other. So if Social Security between the two of you is a big part of your income, if you each get, let's say, $2,000 a month in Social Security and one of you dies, you lose the other $2,000 a month. That's an important thing, because you're spending both of those 2,000.
That's right.
Unless you're saving 2,000 a month and you don't care, it's fine. But most people are spending the money that they're earning each and every month, and they're buying things or bills or whatever it is. So that is important if you are trying to live a life within a budget and then suddenly it changes. So if each of us have an expense in our life and we are in fact whatever, let's say one Social Security is $2,000 a month and one is $1,500. That $1,500 a month, the lower of the two, is what goes away. So if that was yours, you now get his. If that was his, you know, if his is higher, you get the higher, right? So you always get the higher of the two. However, if that person was living a life, financially speaking, as if they were a normal expenditures of those dollars, then that's fine. They were eating $1,500 worth of food. Their insurance was $1,500. Their Netflix, you know, was $1,500, whatever it is. If that's the case, but for most people, it's not that way.
And it's hard to see that for a lot of people. They're more worried about the accumulation side, meaning they're going to save as many dollars as they can. Maybe they look for a job that has an income replacement like a pension, and they know that inherently they're putting into Social Security, and they think, okay, between these two income streams plus whatever I have in savings, I can draw from that. And plus my spouse, whatever they've done, that'll help supplement, and that'll make up our retirement. Okay, well that's a race and a battle in and of itself. You get there, and if you walked into that conversation without any life insurance, and you forget that you lose the lower of the two when one of them passes, that you can't do any planning at that point. I mean, how do you go back and you can't do that? So thinking at least in part of having some type of plan where you can replace, maybe it's not 100% of it. Like Arif said, if one of you brings in $2,000 in Social Security and the other one brings in $1,500, and you back your financial life into maybe living on 2/3 of that, or maybe even a little bit more, you don't need to replace 100% of the one that's lost. You can still say, okay, look, I don't need all of that, but what number makes sense for us so that we're still comfortable if one of us passes?
And you know, a lot of people are looking at this the same way when it comes to pensions, right? Your pension itself can easily be tied towards something where you're going to be getting a certain amount of money, $4,000 a month, and your spouse receives $2,500 a month if you die, right? Because in some cases, the spouse will receive less. So if that were to happen, then you want to insure the one who has the pension, because sometimes your pension provisions say that if I have $4,000 a month and my wife receives $1,500, but if I die, she gets only $1,500. Well, we're going to have to fill that gap if she's used to spending the $4,000. But if she passes away, do I need as much life insurance on her? Maybe not. Because in retirement, her life insurance, if she passes away, I would get a step up, meaning my $4,000 might go to $4,800, because they know once I die, there's nothing left of the pension. My beneficiaries, my kids, nobody gets anything else. It's gone. So sometimes if the breadwinner, the main pension earner, passes away, then we're going to need insurance. But if the spouse dies, you probably don't. So don't think of it as always, I need the biggest number. It's not always the case. So here's where I'm going with that. Your pension features may have a benefit that says, if I die, I want my spouse to receive the same amount. If that's the case, you would probably want to check that box. Unless you're going to do something fancy or you have a lot of other money saved and you can do it, great. But for most people, that's not what they do. They're kind of stuck. So I don't want you to be stuck like that. The pension is another way to set aside some of those funds. When we come back, I want to get into some other reasons why you might want to have life insurance. And why it's important for you to calculate that is because right now, if you have an old policy, it's probably the least expensive it's ever going to be. Now is the time to do it because it's inexpensive and it's probably reasonably priced. Okay, and you can carry that through. We'll give you some tips and tricks on how to do that before you cancel your life insurance policy. Thought you didn't need it? Well, we're here to tell you maybe otherwise, but at least to clarify some thoughts when we come back. Total Financial Solutions, Safer Money Hour. I'm Arif Halaby. That's Jeff Gerard on AM 1220 KHTS.